So the way I see it, the question isn't, why should you work for the NSA? The question is, why shouldn't you?
Why shouldn't I work for the NSA? It's a tough one. But I'll take a shot. Say I'm working at the NSA and somebody puts a code on my desk, something no one else can break. Maybe I take a shot at it and maybe I break it. And I'm real happy with myself because I did my job well. But maybe that code was the location of some rebel army in North Africa or the Middle East. And once they have that location, they bomb the village where the rebels are hiding. 1,500 people that I never met, never had no problem with, get killed. Now the politicians are saying, oh, send in the Marines to secure the area because they don't give a shit. It won't be their kid over there getting shot, just like it wasn't them when their number got called because they were all pulling a tour in the National Guard. It'll be some kid from Southie over there taking shrapnel in the ass. He comes back to find that the plant he used to work at got exported to the country he just got back from, and the guy who put the shrapnel in his ass got his old job because he'll work for 15 cents a day and no bathroom breaks. Meanwhile, he realizes the only reason he was over there in the first place was so that we could install a government that would sell us oil at a good price. And of course, the oil companies use a little skirmish over there to scare up domestic oil prices. A cute little ancillary benefit for them, but it ain't helping my buddy at $2.50 a gallon. They're taking their sweet time bringing the oil back, of course. Maybe they even took the liberty of hiring an alcoholic skipper who likes to drink martinis and fucking play slalom with the icebergs. It ain't too long till he hits one, spills the oil, and kills all the sea life in the North Atlantic. So now my buddy's out of work, he can't afford to drive, so he's walking to the fucking job interviews, which sucks because the shrapnel in his ass is giving him chronic hemorrhoids, and meanwhile he's starving because every time he tries to get a bite to eat, the only blue plate special they're serving is North Atlantic scrod with Quaker steak. So what did I think? I'm holding out for something better. I figure, fuck it, while I'm at it, why not just shoot my buddy? Take his job, give it to his sworn enemy, hike up gas prices, bomb a village, club a baby seal, hit the hash pipe, and join the National Guard. I could be elected president.
Welcome out, Janusian Nation, to our fifth video. We will be starting a series of videos on global energy policy. Those of you who've been following our channel will know that in our last video on OPEC, we promised that we would do a video on our assessment of the Russo-Ukrainian conflict. We did prepare a script and we had probably 3 videos that we were going to do, but we decided to can that project because it's a very emotionally charged topic in society. Now this video is being filmed in mid-November, and it does look like right now that, at least for the time being, there's been a de-escalation in the conflict. While the conflict is certainly contributing to significant energy shortages in Europe, it's our view that we've entered into an era of expensive energy that will last into the next decade, regardless of how the Russo-Ukraine conflict is resolved. Energy prices, as noted in our previous videos, have been rising dramatically to non-energy exporting countries for 2 reasons. Number one is the unprecedented magnitude and rapidity in rise in US dollar interest rates, which has strengthened the US dollar against commodity importing countries more broadly, but specifically energy importing countries. So we can think of the UK, continental Europe, Japan, South Korea as being developed economies that have experienced dramatic rises in energy costs as a result of the US dollar going up. And of course, much of the non-energy exporting developed world has experienced the same thing. The second reason, of course, is the Russo-Ukrainian conflict. There's a pipeline called Nord Stream 1 through which the Russians were supplying German economy, and they were titrating the flows of that pipeline throughout the summer. And as a result, natural gas prices all over the world went up. Now, we've been sheltered somewhat from the rising natural gas prices here in North America because one of the largest export terminals for natural gas in Freeport, Texas, had a fire earlier this summer and has been unable to export natural gas since that point, and this has prevented natural gas prices from rising in North America as much as they otherwise would have. Now, after the beginning of the conflict between Russia and Ukraine, the West imposed a number of sanctions on Russia, and those sanctions have complicated the global energy supply chain and the supply chain for other commodities that Russia exports, of course. These restrictions that Russia has done with the titration of natural gas to Europe have been called weaponizing energy. Now, this tactic, whether Russia has applied it in energy or other commodities that it exports, is effectively the age-old tactic of using a siege mentality, where you restrict the ability of your opponents in war to get supplies. And this is, of course, a technique that dates back to the Bible. The Russian response to weaponizing natural gas was somewhat predictable because the Nord Stream 2 pipeline, a pipeline that was built as additional natural gas capacity to Germany, was essentially denied approval last fall because of American intervention. They did not want increased European integration, economic integration with Russia.
Let me answer the first question first. If Russia invades, that means tanks or troops crossing the border of Ukraine again. Then there will be no longer a Nord Stream 2. We will bring an end to it.
This reaction of using natural gas as an economic warfare tool, as this war with Ukraine, of course, is understood to be essentially a proxy war between Russia and NATO, where the Ukrainian soldiers were trained by NATO, and Ukrainians are being supplied weapons by NATO. And the U.S. and the U.K. were very much in favor of Ukraine not coming to a diplomatic solution early on in the war, and so as a result, Russia has sought, in effect, to fight a war on two fronts: an economic war, weaponizing their commodities, and a military war conflict in the Ukraine. So if we leave that the analysis, the particular analysis of the Russo-Ukrainian war aside, and discussions of U.S. dollar strength, which we've already done in previous videos, and the U.S. dollar as a reserve currency, what we want to do with this presentation is zoom out more broadly to consider why we are in this transition phase towards seeing a decade of higher energy prices in the energy complex overall. And so we're going to consider additional factors. Of course, we'll come back and discuss and list these two factors as part of the overall trend. But we will want to have a more broader discussion on why the energy complex is across the board, why we can expect higher energy prices for much of the next decade. So energy is the fundamental input that powers everything in the economy. And oil is the most commonly used input in the world. It's literally used in the manufacture of everything that we consume, from food to clothing to plastics. And so it's the most important commodity in the world. I always like to bring out that we'd had a tremendous revolution in energy over the last previous 2 decades. And of course, we've seen very low oil prices. Oil briefly was negative during the pandemic, but we've never really lived through an issue of energy scarcity. And it's an important thing to consider as we're moving away from into a multipolar world where we are potentially getting into conflict, say, broadly speaking, a West conflict with, one might argue, the Middle East and Russia and China. So the commodity producers versus the commodity consumers, recalling again that in the West, we consume 45 million barrels of oil a day while we only produce 30 million barrels a day. Now, why is that of a particular relevance to us from a society standpoint? Now, if you look at Maslow's hierarchy of needs, you will notice that in the West, we've been blessed with this abundance, relative abundance of being able to provide for ourselves food, shelter, the basic commodity necessities of life have come to us relatively cheaply in my lifetime. And this, of course, has I know if you're millennials, you're not looking at housing being cheap, shelter being cheap anymore. Of course, this is a big societal problem. And so not having energy becoming scarce to us potentially because of that 45 million barrel a day consumption that we have in the world versus 30 million barrel of production in terms of oil equivalent energy that we use. This puts at risk the stability of our society, because if we take away the ability for the masses to provide for themselves at a very basic level, this is going to be incredibly destabilizing. And so this is why the stakes are quite high on this topic of getting energy policy correct, because it fundamentally drives the price of commodities that we consume that provide us with our most basic hierarchy of needs. So nowhere are the stakes of the potentially economic and societal destabilizing effects of energy scarcity evident than in the German economy. And so we could, as a sidebar, also list the UK, which is a massive energy importer, and Japan and other parts of continental Europe. But Germany gives us perhaps our most stark example. Germany is the manufacturing behemoth of Europe, and their annual GDP is about $4 trillion US. Half of that GDP, $2 trillion US, is dependent on cheap Russian gas, so pipeline gas. So only $27 billion of Russian pipeline gas drives the competitiveness of half of Germany's economy. Now, if that, you could say, well, why can't they just replace that natural gas? Well, because liquefied natural gas, when they import it, natural gas through liquefaction, ends up being 4 times as expensive and makes a lot of those industries uncompetitive. So there is, for example, a BASF super plant in Germany that there are only 4 in the world, and BASF would not be able to function if this Russian natural gas is shut down, and they'll have to look to either reestablish themselves in either somewhere else, either in the West, in which the United States or Canada would be a potential candidate, or in China or India. Germany faces right now the prospect of deindustrialization because of energy scarcity. So the agenda that we have for this, all of this to bring us to sort of the agenda, that is that we are in an era of cheap energy. We're transitioning to an era of expensive energy or more expensive energy. And we want to talk about what factors enabled the cheap energy over the last decade, how those factors in practice have reversed themselves, how policymakers are actually making the problem of energy scarcity or the expense of energy worse. And we want to discuss perhaps how long we think this trend of energy costs rising will last. So to that part, we're going to have a three-part video series. We believe the era of cheap energy is over. This video, how did Western policy makers contribute to this energy crisis, and what can we do to improve energy security through responsible energy policy. So those are the three sort of topics that we want to address through our energy video series. So as I alluded to earlier in the preamble to this video, when I talk about the miracles of technology as being an economic growth driver in the economy, I would often mention, because I teach an energy course, that I thought perhaps the most significant technological breakthroughs had come through in the energy complex. So on the fossil fuel energy side, we saw innovations in unconventional technology like the oil sands, and we saw innovations in conventional oil trapped in rock using advanced hydraulic fracturing techniques. In the renewable side, we saw a reduction in the cost of wind energy and solar. Now, solar saw the most dramatic decline in energy costs, and that was primarily through the Chinese focusing on solar energy and becoming global mass producers of solar panels. Now, there was oil that was trapped, light tight oil and gas, in shale rock or hard rock or shale-like rock. And what they learned to do was they learned to, first of all, drill horizontally. So they learned how to, and they learned how to fracture the rock inside the formation so that the trapped gas or the trapped oil could flow through the fractured rock into. Now, in the United States, there are essentially three shale formations, one in East Texas, which is called, for oil, one in East Texas that's called the Eagle Ford. In West Texas, it's the Permian Basin. And in North Dakota, it's the Bakken. Now, basically, the horizontal drilling and fracking technology was first developed in the natural gas industry, and that happened in the late aughts. Natural gas prices collapsed from $8 to $2, and spent much of the last decade in that $2 to $4 range because the economic reserves of natural gas in the United States effectively doubled from 20 years to 40 years, and the liquefied natural gas terminals, the export terminals, were built so that some of this excess natural gas for the producers could be sold abroad. And now this fracking industry in general has what we in economics would call economies of scale, but at an industry level and not at a firm level. And what we mean by that is when there is a technological breakthrough that increases production, it benefits the entire industry, and one firm isn't able to capture it. So you can imagine economies of scale in a firm like Google, where Larry and Sergey invent search, they are able to capture those all for Google and get the benefit of those economies of scale, that scalable technology of having a search engine. In the shale industry, what happens when you produce oil and gas is the oil companies will have service companies that will come in and do their drilling for them and their fracking. And this might be a firm like Halliburton or Schlumberger. And then they develop a technique for maybe either it's horizontal drilling or it's increased the number of fracking stages and put in more pressure and increase the sand, and they were able to dramatically increase the production coming out of these reservoirs. And so what was happening in terms of vintages of technological change that was going on was it was lowering the cost curve for shale production and making it cheaper and cheaper. And of course, this caused the collapse in oil prices. So oil prices went from over $100 a barrel in 2014, collapsed down into the 20s in 2016. And the other big area where oil production increased outside of OPEC in the last decade was here in Canada. Up in northern Alberta, and it was through a technique that was developed to capture bitumen, be able to extract bitumen at depths greater than 75 meters in the Alberta oil sands. So the oil sands are the oil is in like a tar. It's called bitumen, and it's a tar-like substance. And a technique that was designed where the principal technique for extraction is called SAGD, steam-assisted gravity drainage, and it's where steam is injected into the formation, and companies were able to go in and cost-effectively develop this production for this SAGD. The government of Canada partnered with the government of Alberta and the corporations in the 1970s, and there was a organization called AOSTRA that was created that was a public-private partnership to develop technologies that would help for cost-effective extraction of these this bitumen tar. And to be able to extract it cost effectively. We saw a dramatic rise in oil sands, unconventional oil sands production to the tune of where in Canada we're producing about 2.5 million barrels a day from oil sands and 4 million barrels a day in total. If we were going to total it all up, our conventional production has been relatively flat over the last couple decades. On the natural gas side, despite the fact that the shale revolution actually began in the late aughts on the natural gas side, there's also been innovations in liquefied natural gas. So when you want to export natural gas, you have to essentially liquefy it and then move it across the ocean in a tanker, the same way you would move oil. And this is an expensive process. But if you've got offshore natural gas, they've invented a way that they can essentially combine facilities for extracting the offshore natural gas as well as being able to generate the liquefied natural gas so that they can just have the carrier come up and sort of collapse part of the process, so you don't need pipelines to take it to shore and have an onshore liquefied natural gas terminal, but they'll have a floating liquefied natural gas terminal instead. Now, I was working for Canadian Energy Resource Institute in the aughts, I should say, rather, from 2005, 2008. And during that time, My focus was on renewables more broadly, oil sands, and but specifically looking at the costs of putting large scale wind farms onto the grid and what those levelized costs, we call them levelized costs. So that would mean accounting for both the fixed costs and marginal costs to come up with a long run supply cost. And at the time, when we were looking at, we did a report at CIRI in 2005 for the Ontario Power Authority, the OPA, and we were looking at sort of benchmarking levelized costs of various renewables. Wind energy was at about $120 a megawatt hour, and solar was about $200 a megawatt hour from our analysis that we were doing. What we saw happen over that space of the time since I left CIRI, like close to I should say 15 years ago, is that we've seen a dramatic reduction in the cost of wind generation and solar. So on the wind side, they figured out that if they made the wind towers higher and bigger propellers, they could make wind more efficient. Province of Alberta signed a long-term wind contracts for $36 a megawatt hour. So moving down from, so that would have been in a space of less than 10 years, that we would have went from $120 to having firms sign up for $36 a megawatt hour, which is just an incredible 75% cost reduction. And so you had things, bigger propellers, higher towers, some components changes that drove a reduction in the levelized cost of wind generation. Now solar, solar fell even more or as dramatically, $200 we'll see in a graph here as I'm talking about, we've got something from Statista here, which talks about solar falling from $378 to $68. I've seen numbers where solar in some areas has fallen to below $50. The entire story behind solar is that China got behind it in terms of and started producing these solar panels with economies of scale and really drove the price of these solar panels down. And it's often the case that when I was working at CIRI, that a lot of these projections for the falling costs of renewables were overly optimistic. But in the case of solar, solar has come in decades ahead of forecasts in terms of how much it's been reduced, and it's almost entirely been China economies of scale, big factories get behind the production and build super cheap solar plant panels. So another thing that increased the general trend towards lower stable energy prices over the last couple decades has been the increase in globalization. And probably the two most important elements of that has been the introduction of China as a permanent member into the World Trade Organization, and that allowed for tariff certainty, and so that if companies moved their production to China, they couldn't be exposed under the World Trade Organization to retaliatory tariffs, and that membership of China into the World Trade Organization happened in the fall of 2001. And then the other big event was Europe became more integrated with Russia. And now if we look at Chinese exports, again, sort of looking at from when they've exploded from 2001. and they're up over 10 times in the last decade. And with respect to Russian integration with Europe, there are three natural gas pipelines. Nord Stream 1 is a two-pipe pipeline that was completed in 2011, and then Nord Stream 2, which was essentially a duplication of Nord Stream 1. That was completed last year in 2021, but the USA and the German regulator did not approve its opening, and then TurkStream, which is a pipeline that so the Nord Stream pipelines run from Russia through the Baltic Sea into Germany. TurkStream runs in the Black Sea from Russia to Turkey. So those were the two main factors. So with China becoming essentially the manufacturing hub of the world for cheap goods, and Germany specifically becoming the industrial behemoth, especially for heavy industry in Europe, as a result of cheap Russian natural gas. Now, as we're going to see momentarily, those trends have reversed themselves. So there's basically three factors that are worth mentioning here. One is a lack of investment in the energy complex in general, especially in the hydrocarbon space. A end of the shale revolution in terms of productivity gains, and as we've talked about before, that the world is shifting from a unipolar world to a multipolar world, and this is creating tensions and reversing some globalization. So every year, to stand still in terms of keeping oil production constant, which is about 100 million barrels a day of consumption that the world uses, we would need about between 650 and 700 billion a year to keep up. Now, demand tends to grow on average between 1 million and 2 million barrels a year. It depends. We've only had 4 years in the history of the oil markets where oil has actually declined in terms of year-over-year consumption. Normally, even in a recessionary period, the only thing that's declining is the rate of growth of oil demand. And there has been, because of the shale revolution and the amount of U.S. production that came online rapidly, and because of ESG, the new and government regulations and discouragement of hydrocarbon investment, we've seen a shrink in the investment budgets of oil companies to the tune of about 50%. So since that collapse of oil prices in 2014 that we showed earlier in this slide package, there's only been about 300 to 350 billion a year in investment spending. So if you total up those 7 years of disinvestment, they've created essentially $2 trillion in terms of lack of investment, and global inventories are at all-time lows. Now, American production had a tremendous increase from, as I mentioned earlier, the three main light tight oil basins or shale basins, which are located in, two of them are located in Texas. Eagle Ford is in East Texas, and the Permian Basin is in West Texas, and then the other prominent oil basin is in North Dakota, the Bakken. Why is the shale productivity coming to an end? Well, part of it is that the cost of capital has gone way up for oil producers because the Federal Reserve has raised interest rates dramatically, and because there's in general been both a regulatory and a societal pressure to curb fossil fuel investment. The traditional model on which oil companies were valued were essentially a quest for ever adding reserves. And this ended up in the shale case because of the rapid declines of the shale wells, where you get a decline rate in production of 35 to 50% per year. This led to essentially a blowout of overinvestment. And as the investment model changed to where now investors want to have a cash return and a return on capital, the investment in shale has diminished greatly. There's evidence that the most productive, even the most productive formations are in decline, save perhaps a little bit of the Permian Basin in terms of productivity, which is to say that they're no longer getting increases in production through new vintages of hydraulic fracturing technologies. The U.S. is suffering severe labor shortages and cement shortages. Labor shortages are a function of the fact that the industry was in deep decline with the collapse of oil prices and the COVID. And then, of course, America lost over a million deaths, and there's a lot of COVID long haulers, and so there's people who have just retired from the industry. As we've talked about in the OPEC video that we did, the last video that we did, the U.S. started out in the modern oil industry from 1900 to the early 1970s. They were the swing producers. Then OPEC took over, and then Shale became the swing production in the mid part of last decade. And that baton has been passed back to Saudi Arabia and Russia in terms of the swing producers. And so supply management, which is effectively out of the West's control. Now, the U.S. has something called a Strategic Petroleum Reserve, which was set up in the 70s. And that Strategic Petroleum Reserve has been drained substantially this year. NATO and the United States and the West in general believed that if they were to restrict commodity prices, that they could potentially cause economic collapse in Russia. And I think that this was a tactic. And so I think if looking at it from a military tactic, they sought to diminish the revenue that, and oil is the principal source of revenue for Russia. So given this Russo-Ukrainian conflict, the SPR was used as a economic war tool to diminish Russian profits. Now, there's still over 300 million barrels in the Strategic Petroleum Reserve. However, since about the mid part of last decade, the United States legislature Congress started to pass laws so that they could get passed by the Congressional Budget Office. They would allocate sales from the Strategic Petroleum Reserve so that they could effectively get their bills that they were passing, their spending bills that they were passing, or their tax cut bills that they were passing as being shown as being revenue neutral. Now, the consequence of that is that if you look out to 2030, there's 17 bills that have been passed, and they account for legislative sales of the Strategic Petroleum Reserve that would leave the U.S. Strategic Petroleum Reserve currently only at 111 million barrels, which is next to nothing. So basically, the Strategic Petroleum Reserve, one can argue, is done as a mitigation tool for price management. And in fact, if you believe it needs to be replenished, then in fact it's going to be an added wind at the back of higher energy prices going forward. Although, of course, there's some debate on that element. Another consequence of the Russian invasion of the Ukraine is that there has been a proposal put forward by Janet Yellen, who was the former head of the Federal Reserve, the first female head of the Federal Reserve. She's now Treasury Secretary under the Biden administration. There was a proposal for her to put forward by the U.S. effectively to put a price cap on Russian oil. Now, this is really an unprecedented move, and it's a lot of hubris, because you can imagine that it's essentially Western consumers telling the rest of the world. So that, the Western consumers are telling the other 7 million people in the world how much they should pay for a commodity that they aren't selling. So not surprisingly, India and China haven't bought on to this, and so the price cap is not likely to be very effective. Of course, this strains relationships with OPEC. Dr. Phil, a advice counselor on television, once used to say about people who cheated in relationships, if they'll do it with you, they'll do it to you. And so I think one of the reservations that OPEC's had in terms of supporting the West against Russia has been this reservation that with the price caps, today it's Russia, tomorrow it's Saudi Arabia or some other country in OPEC. And so there's a fear, of course, that that once this pattern becomes established, that it'll become commonplace and used at the drop of a hat. As I mentioned, and as we alluded to in our last video, part of this evolution towards a multipolar world is Saudi Arabia realizing that with the West essentially promoting price caps, Biden administration committing to ending fossil fuels, that the interests of Saudi Arabia and OPEC lie more with Russia and China than they do with the Western world. And so essentially Saudi Arabia has signaled that they are preparing to leave the petrodollar alliance. Also, we shouldn't underestimate the value of the fact that the West has seized about 600 billion of Russian assets. And so this is going to be horrible down the road for the UK, which is a financial center which is essentially predicated on Middle Eastern, Russian, and Chinese oligarchs supporting that financing system. If, once again, on that principle, if they can take Russian assets and seize them, that they could take Chinese or Saudi assets down the road, what you're going to be seeing is a move by these countries to take their financial assets out of Western capitals or financial capitals and prevent them from being able to confiscate them in the future. And so, again, if we look at it, we're in an era where effectively the geopolitical world is essentially the West against, one might argue, the OPEC oil producers, China and Russia. And I guess you can throw Australia and New Zealand in on the West and put in South Korea and Japan in terms of Western allies. And so, but one might argue that this is essentially the forces of globalization are reversing, and we're in an era where the financialized West is going to be in conflict, perhaps even on an ongoing military basis. It certainly is now with the Russo-Ukrainian proxy war. So one of the things that you've heard bandied about by our politicians that's become the new truism as well. This Russo-Ukrainian conflict underscores the need for us to transition at a quicker pace from a carbon-based economy, decarbonize our economy as much as possible so we reduce our reliance on Russia and OPEC.
From my perspective, this price increase in fuel costs is a reminder of why climate action is so important and why, as a country, we have to work even harder and move even faster towards a green economy. It's an insurance policy against higher energy prices.
And there's a certain logic to that, which is appealing, of course, on the surface, which is that we consume 45 million barrels a day in the West of oil, and we produce only 30 million barrels a day. And it's not realistic that we're going to reduce our consumption without switching to something else. Now, the problem with that, of course, is that it turns out that the path towards electric vehicles and transitioning our transportation system to electric vehicles actually, and renewables, flows through China. China is the dominant solar producer, and China, as we'll see momentarily, also is a major gatekeeper in terms of electric vehicles. So, unfortunately, the path towards switching to electric vehicles and towards renewables is not going to be our savior. Many countries are looking at dramatically, through legislative fiat, dramatically increasing the amount of electric vehicles that are going to be sold. In Canada, we have a mandate that by 2025, we're supposed to have somewhere between 20 and 30% of the vehicles sold in Canada are electric vehicles. These numbers are completely unrealistic. And they're unrealistic primarily because we are looking at, in terms of electric vehicles, and these goals are in the United States and they're in Europe as well, is that we have a complete lack of rare minerals that are needed for the production of electric vehicles. And there's about 10 of them. So we've got copper, graphite, nickel, silicon, zinc, chromium, magnesium, lithium, and molybdenum. The existing stock that we have versus our estimate of 2030, we need to either a doubling or as much as 17 times in terms of graphite increase in production. And one could argue, well, prices will save us and production increases will happen rapidly. Well, there's never been a case in a decade that production has increased in any mineral more than 100% in the space of a decade. Now, you can argue maybe copper in that case would be the one that could expand to meet demand. There are so many choke points that are listed there that it's difficult to believe that we could, under any even kind of, moonshot Apollo program, get ourselves to where we are going to be producing enough minerals to meet the EV demands for our legislative requirements. This is further complicated. Now, if you want to compare by the fact that China controls much of the actual ownership of the critical minerals, as well as the processing. Russia has less than 1/10 of U.S. GDP. China, by some measures, is certainly comparable. Some measures, they have a larger economy than the U.S., Other measures are slightly smaller. The point being that the geopolitical adversary of the United States as we move away from the multipolar world is concentrated in China. And China has control of much of the choke points of the green economy. And if we look at, if we add China and Russia together, of the rare minerals that are needed in the production of EVs, they control over 50%, or approximately 50% of them for over 50% of the minerals. Substantial portions of the critical minerals, and even more importantly, the processing, are done in China and through China and Russia collectively. And the West itself does not have much in terms of ownership of these rare minerals. So this begs the question, are we going to create proxy wars in Africa to change governments that expropriate these assets to Western friendly? How are we going to gain access to these when China already owns them? Now, if we take away the fact that we don't actually have the materials to make electric vehicles, we have another basic problem. And one of those problems is that renewables, solar and wind, have a quality called intermittence. The wind doesn't always blow. It doesn't always blow at the same speed, and the sun is not always shining, and the strength of the sun is not always the same. And this quality is called intermittency. Now, when you look at traditional costs of electricity, normally what you do is you look at costs that are what are called levelized costs, and you're basically adding in the fixed costs of production, the costs of transmission, the capital costs, and the variable costs. Now, if we look at Figure 16, with respect to wind and solar, we do not have cost-effective storage options. So ideally, what we would like to have, which would be our unicorn technology breakthrough in electricity, would be to have some very effective storage. And so if we look at in the wind and solar category for levelized cost of existing versus new energy sources, we see some categories that are for wind and solar that are not included in what we would call the traditional energy sources, which are nuclear, natural gas, and coal. What those categories are that are required are load balancing and overbuilding or curtailment. Wind resources are often not located directly close to load or directly close to the consumers. And so then you have to build out expensive transmission lines. And because wind speeds can vary, you either then the electricity system needs to be balanced on a moment-by-moment basis. You have only a certain amount of electricity that can move through your transmission wires. So you can either build that for overcapacity to, say, have reached the maximum that wind and solar could produce, or you're going to have to do something called curtailment. You're going to have to, when there's more wind and solar energy being produced than the transmission capacity that you built has, then the system operator would essentially take some of that power, some of that generation off the system and curtail it. And there's costs to that because it's being produced and there's a curtailment cost. So you and then what's more is because you can have reasonably rapid fluctuations in wind and solar energy, then you also need to have what's called load balancing. And load balancing is typically done through what they would call natural gas peaker plants. Then you can see that the levelized costs of new energy sources, when you incorporate the concept of either overbuilding transmission or curtailment and load balancing, that those costs go way up and way exceed the levelized cost of the traditional hydrocarbon and nuclear sources. Furthermore, right now, if we wanted to convert every car in the United States into an electric vehicle, we would have to double the capacity of the electricity grid. And the transmission grid is extremely expensive. Nobody wants transmission wires in their backyard. You need, because renewable resources are often in remote locations, you would ideally need to have some high voltage electricity being built. And the grid system is old. So there's an irony here. If you look at the U.S. transmission infrastructure, on average, it's about 40 years old. Parts of it are over 100 years old. And in August, you had California banning the sale of internal combustion engine vehicles by 2035. And in August, you had California asking for its EV drivers to not plug their cars in because the system couldn't handle all the electricity demands that were being demanded in August. And they were threatening blackout or brownouts because of the inability to handle all the electricity demand. So the EV cars were being asked to not charge. So this is the contradictions that Western governments are struggling with. They haven't built out their electricity infrastructure. So there's issues around building out infrastructure and capacity to support the electric vehicle revolution. So in the meantime, we can look at this chart that is, there's an energy investor, one of the largest in Canada, Eric Nuttall of 9 Point Energy Partners, and he points out that if you look at much of our space in both Canada and the United States right now in terms of energy companies, many of them are trading for an economic value that is less than 3 times their cash flow, which is to say that these companies could privatize in under 3 years, many of them, and that their cash flow yield is somewhere on a level of anywhere from 25 to, well, the median grid there looks like it's about, the average, I guess, is 23% from his chart. Now, another way of saying that, of thinking about that, is that these stocks are in the market are essentially priced historically low in terms of their market multiples, to the point that their cost of capital has gone up, and there is some skepticism as to what their long-run profitability is. If we look at how recent public policy decisions, there was a pipeline that was under the Obama administration, a Keystone pipeline that runs from Alberta into the United States, That pipeline was canceled by Obama, reinstated by Trump, recanceled by Biden in 2021. Our own Prime Minister Trudeau is imposing CO2 emissions cuts on the oil sands that are supposed to be 45% of their 2005 levels by 2030. We've seen European Union and USA actively considering windfall tax on oil producers. The European Union and UK have actually enacted those windfall taxes. So what we're seeing essentially is taxes, increased regulation, and constriction of infrastructure that is essentially restricting the ability of hydrocarbon energy to supply to increase. So in the wake of this, what we will be expecting, of course, is supply to keep contracting and prices to go up. And that price of, especially of oil, since it's an input into everything, is going to be inflationary because it's going to effectively be a supply shock, and then it flows through into all goods, including food, and it threatens, as I talked about earlier, the ability of the economy to deliver the most basic level of needs in Maslow's hierarchy of needs to the consumer, and therefore is politically destabilizing. So if we look in summary of this, it seems that we're not yet at a point where the West can accept that we need to engage more constructively with the Middle East and Russia and China. And we're still sort of in denial of this implied energy deficit that we have in the West, which is a liability because energy is life. We consume 45 million barrels of oil a day, and we produce only 30 million barrels of oil a day. And we need to have this, we need to be able to deliver this cost effectively, this 45 million barrels, because otherwise our standard of living is going to be radically reduced, and potentially the stability of our economy, of our democracies, are going to be destabilized with food and energy and rent inflation that will come as a consequence of this. Now, one of the things that gets argued from time to time is that oil and energy markets go into boom and bust cycles, and these higher prices will lead to greater production and invariably overproduction. And in fact, this is a pattern that has happened in the oil in the industry. Thinking about what happened last decade and the factors that bring us here is that we saw last decade with the shale boom, we saw a tremendous loss of investor capital, $550 billion from 2010 to 2020. The investment model in oil has changed because investors now want returns, and they're not willing to just get on a production treadmill. We see investors concerned about environmental sustainable governance and these rules around investing, that the world is moving towards decarbonization. There's been some organizations like the IEA that have suggested that we do not need any new oil production. So there's this debate about whether we should even have any more investment. It does not look like we're in an environment where, absent some signaled policy changes, where even high prices are necessarily going to lead to increases in oil supply, because we are afraid and restricted here in the West with our policies and the regulatory environment that we're operating in. Now, this is highlighted by, if we're looking out to 2040 and we're looking out at this chart, you can see that right now the amount of oil that is demanded and the amount of oil that is supplied is around 100 million barrels. And if we can get ourselves on a trajectory that, say, in the next 5 years or so, we start to reduce and we get to past peak oil demand, then we could see oil demand declining, and that is the bubbles that are we can see the bubbles in the light blue that are declining, where oil demand is essentially declining from 100 million barrels or slightly above to somewhere between somewhere around 70 million barrels between now and 2040. I'm going to suggest that's relatively optimistic, because even if we get our demand down here in the West, there's no guarantee that Chinese or Indian demand is going to decline. And the developing economy would like to see their income standards go up, and the energy intensity of oil it's so productive for these economies that I see that if we decline our demand and prices actually stabilize in that vacuum, that we, or even decline because of our declining demand, we could see an uptake in oil demand that would come from the developing economies, and they are not signed on to constricting their consumption of oil. A relatively optimistic scenario, we see a supply gap with somewhere around between 250 and 450 billion barrels of oil equivalent in terms of energy that we need, that we currently don't have investments for. So this is going to be problematic for us. Warren Buffett has a saying that when the tide goes out, you get to see who's naked. And so you can see that in the next few years, this gap between supply and demand for energy is going to become more evident, and all forms of, particularly in the hydrocarbon system, we're going to see these this disinvestment, even irrespective of how the Russian-Ukrainian conflict gets resolved. We're going to see higher prices than we have now, especially once we're out of sort of the global recession that we're in right now. And these policies of disinvestment are going to be exposed, and they're going to be a source of ongoing political tension. So, going forward, we want to ask the following questions in our future videos. How did the Western policymakers sow this energy crisis? And going forward, how can we make responsible decisions and reverse course here and end up with energy policy decisions that are more in line with providing a stable economic environment for our working class, and providing an off-ramp for our working class while we are still addressing these issues around climate change. So we can't deny climate change, but we also don't want to create energy prices that are so costly that we get political backlash and that we don't have any climate change response. So what might be a more constructive set of energy policies that allow us to effectively address both our economic needs as well as our needs to address our climate change issues, and to promote transition away from hydrocarbons over the longer term. So those are the things that we're going to be discussing in future videos. Thank you, Janusians, for watching this video, and see you soon.